Watching Trading Day on BNN Bloomberg. We're tracking the real estate sector. It is the best performing on the TSX over the last month. It has outperformed the index. Of course, we know that it is coming from a year or more, actually, of underperformance. But this also comes as we've now got 2 rate cuts under our belt in this country. For perspective on the momentum that the REITs seem to have and whether it can continue, where you want to be positioned, let's bring in Matt Kornack, real estate equity research analyst at National Bank. Matt, thanks so much for being with us.
Thanks for having me.
So you're popular again.
I've got a bit of a spring in my step. I'm not sure how long it's going to last, but we still need to thread a needle here. I mean, ultimately, rates are starting to come down. But we've seen it that the Canadian consumer is under pressure. So we're looking at an economic environment that's maybe not as certain here as it is on the other side of the border. And to a prior comment from one of your interviewees, like, we need to see the U.S. see rates go lower so that Canada can continue on this path. And then we do have mortgages that are coming due over the next couple of years that are at much lower rates. So the Canadian consumer probably doesn't get better, it gets worse.
All right, so you're speaking like somebody who's been burned.
Yeah, for a while.
Yeah, for a while,
yeah.
Burned in this sector. So you want to be cautious about it. But there's no denying that real estate has been the go-to bond proxy area in the market, not telcos, to some extent utilities, but it is real estate right now. It doesn't. How meaningful on a fundamental basis are these rate cuts?
So I will say the bulk of the Canadian REIT index is fairly defensive. So that's what gives us some comfort in this environment. And that's how we're positioning in terms of picking REITs right now. Like, we like Canadian multifamily. The fundamentals are exceptionally strong. They're defensive. Rent control kind of spreads rent increases over a period of time. So that we're comfortable owning. If you go into grocery anchored retail, we like it. It's a defensive space. And then you have the grocer oriented names like Choice or CT that have pretty much are a bond proxy at the end of the day. So you can play real estate through those names. I think we're more cautious on office. We're more cautious on enclosed malls. Even, I mean, we got a little bit constructive on Storage Vault, and then they disappointed a bit in terms of the revenue growth number. So you have to be careful. Interest rates are good for all of these names. They're better from a flow of funds perspective, honestly, in the short term, because we are seeing capital come back to the space, and that's important. But the valuations aren't necessarily cheap in the context of longer-term bond yields.
Before we get into what you do like, let's talk about what you're staying away from, and a recent downgrade of Allied, Property REIT Primaris, as well as BSR REIT commonalities?
So I think there are some commonalities there. Obviously, the office has been challenged for a while. I think it's a long workout period. We like the assets that Allied has location-wise, but we're not sure the fundamentals are going to shift immediately. And the balance sheet has gotten a little bit worse there. So we'd like to see some changes. We'd like to see them expedite sale processes. That may come. They it's about the consumer.
Before you move on Allied, they didn't ever cut their dividend.
No, that's another
And it's
issue.
up 10%. The yield at if you bought it now is at 10%.
Yeah.
Is it sustainable?
Our view is that they should cut the dividend, retain capital, and continue with the disposition program. The management team seems pretty sure that they're going to keep it. And if they can dispose of assets at low cap rates and pay down debt accretively, then maybe they can thread that needle. But I think they should probably cut, and I think the investor reaction to a cut would be negative. That was part of the calculus in the downgrade as well. Again, they don't need to cut this year. I don't anticipate that they will, but over time, as leverage becomes an issue and paying down debt does, if they can't sell assets, they will probably have to cut.
I interrupted you. You were continuing on Primaris.
Yeah, so Primaris, again, we saw negative retail sales read through last month or for earlier in the year. I think we are a little concerned there. Now, their balance sheet's in great shape. Their payouts pretty good. They are more defensive than a traditional mall. They are secondary market focused. So all of that is an offset to what we're seeing. But needless to say, the stock had done relatively well, and we are concerned about what the Canadian consumer looks like over the next couple of years on discretionary items, and that's more in the enclosed mall space.
Let's talk about ones that you do like, including recent upgrades, Nexus Industrial, and I'm going to make you talk about a Storage Vault that you upgraded, and then, it didn't do well post-earnings.
I think it's at the same price at which we upgraded at. It went up and down in between. That wasn't necessarily a near-term move. I actually think the interest rate environment is more conducive for that story. So as we see rates come down, it should spur housing activity, which ultimately leads to better revenue growth for that story. And it doesn't pay a dividend. It's an earnings compounder. So all of those things we like about Storage Vault. It sounds like June wasn't a great month. It may bleed into July. So my confidence for Q3, we've definitely pulled back our revenue growth forecast there. But needless to say, it's almost a 6% implied cap rate at current pricing as well. We think it's pretty cheap for an asset class that you can only get through this vehicle in a publicly traded vehicle in Canada, and a heavily sought after one as well. So.
I guess it's worth mentioning that as you advocate for risk-off mentality in REITs, the market over the last month has been going to Allied, to First Service, to Colliers, to Altus, like right there in office. So they've been going all the way on the end of the risk spectrum.
So my experience with rate cuts has never been good. Like REITs, traditionally speaking, don't do well when rates are dropping because they're economically sensitive at the end of the day. Now, there are absolutely defensive names within the space. But if you look at 2007, the only question is this different? Are we going to get 25 basis points, 25 basis points, 25 basis points? And the economy is going to kind of be there. Arguably, we probably need 10 rate cuts to get to a mortgage level for people who have maturities that are coming up in 25 and 26. And they're still going to see double their interest expense. So I'm not confident that the Canadian consumer is going to be in great shape. Now, if you look beyond that, we've had huge population growth. We have to spend a bunch of money on infrastructure. All that's positive eventually. It's just in this intervening period, I think you need to be cautious. You really do.
Okay, Matt.